Hi everyone, welcome to episode 5 of Fridays with FEMA. This is Ashish and I lead the tax and regulatory practice at Parakram.
Hi, I'm Janisha. I lead the corporate and regulatory practice at Parakram. So here we are, and continuing with our previous discussion around ODI laws. In today's podcast, we're going to discuss about employee incentive schemes and how that's dealt under ODI laws. With that, we are also going to discuss some tax aspects and the tax treatment on this topic because this discussion would otherwise be incomplete.
That's right.
Right?
Perfect.
Okay, so I think Ashish, let's get started.
Sure. So I think first question to you, Janisha, is that under ODI laws, uh, is what kind of employee stock incentive schemes are permitted? Is it only the ones that we hear about, the most common one being the employee stock option plan, or are others also allowed?
Sure. So I think just two things that we need to keep in mind when we are talking about employee incentives under ODI laws. Firstly, an employee or a director of an Indian branch or an office or a subsidiary or any other company in which the foreign entity has any equity interest, only such employees or directors of this Indian branch slash subsidiary slash entity are eligible for any ownership interest in the offshore entity through an employee benefit plan, right? So that's point number one. So it's very important for the offshore entity to have some presence in India, either by way of an office branch or through a subsidiary or through any entity in which it holds an equity stake before it thinks of giving any equity incentive plan to the employees working in India.
Sure.
Right? So that's point number one. Point number two is the language under ODI laws is very broad. It's not limited only to the traditional vanilla employee stock options plans that we generally understand. It includes any equity incentive linked benefits that are given to employees slash directors out here in India. So that would also include something like an RSU or the restricted stock unit plan, right? So that's so Ashish, to answer your question, it's pretty wide. Any
Sure.
permutation combination of equity incentive plans at the offshore level would be covered in the scope of the ODI
Sure.
laws.
So interestingly enough, even from a tax perspective, there is no. I mean, the definition is quite wide, and if you are holding a specified security under any employee incentive plan or any by whatever name they are called, they would generally fall within. For tax purposes, it would be considered to be an employee incentive plan, and you could hold
Right.
shares around that, and the taxation would be similar to that as it would be for an employee stock option plan.
Understood. Okay, fair enough. I think Ashish, just moving on, right? In terms of what are the key parameters one needs to keep in mind
Yes.
when we're talking about an incentive plan for employees. Let's first talk about ODI laws. So I think the law says that the offshore entity needs to offer the incentives, employee incentives, on globally on a uniform basis. So
That's
these
right.
three words, globally on a uniform basis, has always been a mystery. It's not a new introduction. This language was there even in the
Australia, yeah.
previous law. Yeah.
Yeah.
So I think, and there are a lot of views around what really this means, right? Because there is really no direction. The way we have thought about this is that the objective should be that there are principles uh, that there are similar principles for employees of different jurisdictions of the offshore company. So let's say the employee benefit plan of for the India employees and the employee benefit plan for, let's say, the French subsidiary, for the employees of the French subsidiary, they are similar in terms of concepts. Like there should be similar transfer restrictions, there should be a concept of vesting, the opportunity to liquidate should be similar, right? To that extent, there should not be any sort of disparity.
Sure.
However, there can be certain nuances or differences for an Indian employee versus a non-Indian employee, which may have some commercial rationale or nexus, right? For example, your vesting schedule might differ, right? And the vesting schedule for employees in another jurisdiction might differ. That might arise because of local law requirements as well in that jurisdiction. We never know. exercise price could be different for different category of employees, right? Until the time there is a commercial reason for the same, that should not be considered to be in violation of this principle of offering ESOPs globally on a uniform basis, right? So I don't believe that should take away from the uniform basis
No,
criteria
absolutely.
out there.
No, I think what you likely correctly said, right? I think it's all dependent upon a commercial rationale.
Yeah,
I think the idea behind the regulations is that the Indian employee should not be shortchanged
yeah, exactly.
for giving them a plan which is less
Favorable.
beneficial, yeah, less
Yeah,
favorable than to any other employee of a foreign entity. And I think that is why they have kept it to be on a globally uniform basis.
right, right. Okay. So I think moving from
Yeah,
there,
so I
yeah.
think the other question that comes to my mind when we talk about employee incentive plan is whether this is going to be considered to be ODI or OPI. We've been
Hmm.
discussing that the last couple of sessions, and
Right,
yeah,
right. So I think just to refresh everybody's memory, ODI is equivalent to higher compliances. Very simply put, OPI is more relaxed in terms of compliances. So if you're an individual who's holding shares of an offshore entity through the ESOP or the employee benefit plan route, if it's less than 10% without any control rights in the offshore entity, it will be considered as an OPI. um, and the filing or the reporting requirements are required to be made by the Indian office slash branch slash Indian subsidiary of the offshore entity through by way of the form OPI. If you're holding more than 10% or you have control in the offshore entity under through the ESOP scheme, then it's considered as ODI, and the filing requirements would vary accordingly.
sure.
So that's with respect to whether it's OPI or ODI. Just some of the offshoots on, since we are on this point, some of the other ancillary points. When one is investing in the offshore company through the ESOP or the employee incentive plan route, a lot of restrictions that are applicable under OI laws for individual do not apply.
Right.
For example, resident individuals directly investing in the offshore entity, they cannot invest in an offshore entity engaged in financial services. But that limitation does not apply if you are investing through the ESOP route.
Right.
Right, so that's another interesting takeaway, and why this route might be more favorable. Thirdly, there is no limitation or outer cap in terms of the amount of money that you may remit by way of an exercise price as an individual. That will be counted towards your LRS limit, but there is no limitation in the sense of the amount you're remitting. So, let's say if you're remitting $100,000, to that extent, your LRS limit will get reduced. So, I think these are some of the smaller points to be kept in mind.
Sure. So I think we've spoken about exercise price and when the money needs to be remitted. But let's talk a little bit on cashless as well, right?
Yeah,
And I think
yeah.
two situations that we can talk about, right? One is cashless where there is no exercise price that has been determined by the
Hmm.
offshore entity, where you are just getting the shares at the time of exercise without really
Right,
sending any money. And the second one, and this is slightly novel, is when actually there is no exercise price to be paid at the time of receiving the shares, but at the time of the liquidity event,
hmm.
the price that the foreign entity wants to charge at the time of exercise is actually deducted from the sale consideration and then paid to the Indian employee. would
Right,
that would that be okay? Would that also amount to a cashless exercise? Your
yeah.
thoughts?
So I think let's talk about the first option,
Yes.
right? Where you are, and just for the benefit of our viewers who may not be familiar with how the ESOP works, there are three steps. One is you are granted an option, then basis certain parameters, those option vests, which means that now you have a right to claim the underlying share. And then when you actually exercise your right to claim the underlying share, it's called an exercise. And at the time of exercise, you may or may not have to pay an exercise price. So, coming to Ashish's question around what if I don't have to pay any excise price at all, that should be okay till the time you're complying with all the other requirements under OI laws in terms of offering ESOPs on a uniform basis and filings and everything else. So I think that is fine. Let's come to your second example where my exercise price is deducted from the proceeds I'm getting when I'm selling my shares in a liquidity event, right? Now, this technically won't work from a FEMA perspective, because the moment the exercise prices, in this case, has become a payable for me, and I'm an Indian resident out here, right? So it's a payable or a liability for an Indian resident outside India, which is now being discharged through adjustment of that amount through the proceeds of a liquidity event, and this becomes a capital account transaction.
Right.
Right, in a previous episodes we've discussed that a capital account transaction is creation of an asset liability outside India for a person resident in India. If you have that payable outstanding, it becomes a capital account transaction, which is not explicitly permitted under FEMA, and hence it would be prohibited.
Sure.
So yeah, I think that's how we need to look at the cashless structuring options. Yeah.
Okay, wonderful. So I think from a tax perspective, I think
Mm.
what needs to be understood is that when an Indian employee is receiving shares under an ESOP plan or an employee incentive plan, they are considered to be perquisites,
Mm.
and they are taxable as perquisites. They are taxable as perquisites, where the taxation is equal to the tax bracket of the employee, which means it is like a salary that is being paid by the employer to the employee.
Sure.
And
So, but Ashish, one just before that, if we can also discuss at what point of time is the
sure.
employee subject to tax? Is it at the time of grant, vesting, or exercise?
Sure. So, like you mentioned, there are three stages: grant, vesting, exercise. Now, at
Mm.
the time of grant and vesting, typically there is no tax that is payable from an Indian tax perspective.
Mm.
Tax becomes payable only when there is an exercise of the option,
Mm.
which means that the employee is actually receiving the shares of the foreign entity. At that point in time, there is a tax that is
Mm.
payable by the
Mm.
employee. Now, this tax, like I said, is characterized as perquisites. I mean, the shares received by the employee is characterized as perquisites and taxable on as per the tax bracket of the
Mm.
employee. The tax is on the difference between the fair market value of the foreign company
Mm.
and the exercise price that the employee has to
Mm.
pay, and
Understood.
that difference is what is on what you have to pay tax.
Right. So Ashish, let's take two situations, right? I think one is when the exercise event is linked to the liquidity event, which a lot of employee benefit plans do provide for in order to ensure there's liquidity to discharge the tax liability.
Right.
So how would the tax treatment work there? And in scenario two, where I've exercised before a liquidity event, so I think basis what you tell me that at that point of time when I'm exercising, I'll be subject to perquisites, and subsequently when I'm selling those shares, what is my tax treatment in that
Sure.
situation?
So let's take the first
Hmm.
example, right, where we are there is a liquidity event taking place, and we are the exercise is taking place
Right.
along with it. Now, in that situation, once the exercise takes place, it should result in, like I said, a perquisite event
Hmm.
taking place, and the employee would pay the tax between the fair market value and the exercise price.
Hmm.
Now, once he has done that, the employee has now got shares, the cost of acquisition of which has increased because you have paid tax on the
Hmm.
difference. The cost of acquisition is now the fair market value of the
Hmm.
foreign company. So therefore, now if the sale is taking place in a liquidity event simultaneous to the
Hmm.
exercise,
Hmm.
then assuming that the sale is
The
also taking
same.
place at the fair market value,
Hmm.
then there is no further tax in the hands of the
Right.
employee.
Right. So a
In
step up here in the cost of acquisition would be relevant, and if it's the
Correct.
same price and there is no capital gains.
Correct. So
Yeah.
the idea is that once the share comes in the hands of the employee, it's a capital asset,
Hmm.
and then the second step is the sale of a capital asset, which will result in a
Hmm.
capital gain treatment.
Hmm.
Now, in a situation where I am holding on to the shares and not
Hmm.
selling them immediately, then the clock would start ticking from that point in time to
Hmm.
determine whether it is a long-term capital gain or a
Hmm.
short-term capital gain, and then
Hmm.
tax is payable accordingly
Sure.
by the Indian employee.
Sure.
Now, in the other example that you said, that now I have exercised it much before, perhaps when the fair market value of the foreign company is far
Hmm.
lower,
Right.
and now I am selling the
Hmm.
shares. Now, in that situation, possibly the exercise had been done thinking that you could hold the shares for a longer period of time so that you could pay the capital gains tax.
Right.
Now, in this situation, if the fair market value of the foreign company is significant, then your tax liability also is significant because you are holding the shares. Your cost of acquisition of the shares is also going to be very small. So to give you an example, let's assume that you exercise the shares at 10 rupees,
Hmm.
right? And that time the fair market value of the foreign company also was 10 rupees, right?
Hmm.
So now your cost of acquisition as a capital asset that you're holding of the foreign company has now is 10 rupees, and now if the secondary is taking place at a 50 or 100 rupees, then the difference between that 150
Right.
and the 10 is become taxable as
Right.
capital gains.
So while in this situation, my perquisite tax outflow might be less because my fair market value was low at the time of exercise. But when I'm doing a subsequent sale, that and if that time the fair market value is high, that's when the capital gains tax liability could be
Absolutely.
significant.
Absolutely.
Right.
And this becomes quite relevant in a foreign situation when there is a share swap taking
Yeah.
place.
Yeah.
Typically, in cases of a triangular, reverse triangular mergers, where the ESOP of the foreign entity is usually cancelled and then it is issued by the acquirer entity.
Mm-hmm.
Now, in a situation where the ESOPs have been exercised by Indian employees, they would be getting new shares of the acquired entity,
Right.
which possibly may be of a higher value.
Right.
Right now, in a share swap situation, you have only got new shares, not
Money.
money, and therefore the difference between the value of the new share and the share that you had to extinguish becomes subject to capital gains tax in India, uh, which has to be kept in mind,
For which you'll have to
for
pay
which you
out
have to
of
pay out of
pocket.
pocket.
Right.
Absolutely, and that is a significant consideration in those
Right.
situations.
Right. I think interesting thoughts there. So I think with that we can close this particular episode, and we hope you all enjoyed listening to this. And let us know your comments and what you would like to hear more from us in the next few episodes.
Sure, look forward.
Look
Thank
forward.
you.
Thank you.